The money part is the struggle, right? For a lot of people. How do you get over that hurdle?
So where does the money come from? You don't need a good credit score to invest in or operate a large commercial multifamily property. 1 to 4 units residential, it all boils down to your debt to income ratio and your credit score and your credit worthiness, right? For large commercial, it has nothing to do with it. It's all based on the operations of the property and the team's capacity to execute the business plan. The money is usually raised through passive investors. That is how these big deals are done. It's not like one person or two people are like partnering on a deal and they have all the money themselves. No. You leverage a mortgage just like you do for a single family home. So you get commercial debt, and commercial debt, you can get 75% of that total purchase price could be leveraged using commercial debt. And the larger deals are actually easier to finance, and they're called non-recourse debt, where if the loan defaults, there's no recourse on the individuals that signed on the debt. It's just the bank just takes over. Smaller loans that are in commercial property, just like your own home, if you fail to pay the debt, there's going to be recourse. You're still going to owe that amount. So that's the difference. Let's say the bank puts $7.5 million down. They give you a mortgage as long as you could prove that the operations could pay that debt service based on the numbers that you were given. And this is how you have to learn how to underwrite and analyze these deals. But then now you have to come up with $2.5 million to pay for that $10 million property because they're lending you 7.5. So now the cool thing about commercial real estate is that you can get creative. It's not like you always have to go put down that $2.5 million because guess what? A lot of these properties, the seller is maybe just old, or they're just tired, or they don't have the time, but they really like the asset. They're just ready to sell. Maybe they still want to be part of it. That's where you could take advantage of seller financing, where you could like tap into the seller, get their appetite for it. Maybe they're willing to lend you $2.5 million of that 3.5, and that'll just be added to your debt that you pay back every single month as long as the numbers work. So then you really just have to raise $1 million. And that's where you can go to people like Keith. It's just all about finding those individuals, not asking them for money. This is a capital raising 101. When you're raising capital, you're not asking for money. You're literally taking this opportunity and you're offering it to investors who already want it. You need to go raise $500K. You could literally get $100K from 5 different people, and you're offering them an opportunity because in exchange for that $100K, they're going to get incredible returns and they're going to be an owner in the property. Those limited partners own more of the deal than the general partners who are doing most of the work. Let's say you raise that $1.5 million on this particular deal. These are funded and structured. It's a split between general partners and limited partners. And the general partners do all the work. They found the deal, they did the due diligence, they ran the numbers, they raised the capital, they're operating. Those are the general partners. They might own anywhere from 20 to 30, maybe to 40% of the deal. But those limited partners who invested are going to own 60, 70, or 80% of the deal. So it's not a bad position to be a limited partner. By the way, you don't do any work. You literally collect mailbox money. I don't want to spend the time being a general partner anymore. I want to be a limited partner, and because I know how to analyze deals, analyze teams, analyze markets. So once I do my due diligence, I park money and I don't have to worry about it. I just receive updates every month from the general partnership.